When it comes to investing, long-term investors are less concerned about the near-term speed bumps and more concerned about the longevity of a company. Being a long-term value investor myself, there's a few qualities I look for within each company. One being they have a wide moat, meaning that they have staying power. The second being revenue and earnings growth. And the third being valuation. And in today's video, we're going to take a look at 3 companies that check each of these boxes. And I believe these are 3 companies that should be on every investor's watch list right now. But before we begin, do me a huge favor. Click that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is Cashflow University. Cashflow University, or CFU, is the premier options community, a community that I am a part of as well. If you're looking to generate income utilizing option strategies or looking to learn and educate yourselves around options, then Cashflow University is the perfect place for you. The focus for CFU is less on YOLO high-risk trades and more on trades that will generate you that cash flow on a weekly and monthly basis. Right now, they're running a special promotion where if you click the link down in the description below, you can get 25% off your first payment to check out Cashflow University today. With that being said, let's jump back into today's video, taking a look at 3 high-quality companies that I believe should be on every watch list right now. Beginning with watch list stock number 1, which is Alphabet, stock ticker GOOGL. Alphabet just recently released their most recent earnings report, and it was flawless. One of the best reports I've ever seen. Regardless of what angle you look at in this report, it was just impeccable. The company is one of the largest companies in the world today, but the growth potential remains quite high. They have a market cap of $2 trillion, and over the past 12 months, the stock is up 58%, and year to date, they are up nearly 20%. Let's begin by taking a look at the company's latest earnings report that I just alluded to. They reported EPS of $1.89, which beat analyst expectations easily by 38 cents per share. Revenue came in at $80.54 billion, also easily beating analyst expectations by $1.84 billion. That is a massive beat. Revenues grew 15.4% year over year, and operating margins came in at 32%. Alphabet is a huge company with various different segments. They have a lot of irons in the fire, whether we're talking about Google Search, YouTube, advertising, cloud, and many other areas. Looking at performance, we saw Google Search revenues increase 14.4%, Google Cloud increased 28.4%, advertising saw their revenues increase by 13%, and YouTube ads was a bright spot, increasing 20.9% year over year. So right there, you can see across the board, regardless of what segment you look at, it was just an awesome quarter. And that was enough to increase the stock price after earnings for pretty much any company out there. But that's not all they announced. The company also announced a $70 billion share repurchase program. Oh, and there's one more thing. They announced a dividend. That's right, Alphabet is now a dividend stock. And that's rather exciting considering it's my largest holding. Now let's take a look at valuation, even after shares moved higher by double-digit percentage points after that amazing report. For 2024, analysts are looking for the company to generate $7.49 per share in EPS. That's 29% EPS year-over-year growth. That gives the company a forward PE multiple of 22.2 times. Over the past 5 years, the company historically trades at a multiple of 25.3 times. So even after that move, shares still offer a ton of upside for investors. Analysts are still looking for 15% upside, with an average 12-month price target of $192 per share, and a stock I believe has not even had that AI pixie dust sprinkled over it like some of the other Mag 7 stocks have. And that leads us to watchlist stock number 2, which is Generac Holdings, stock ticker GNRC. Generac isn't a company that we've covered on this channel, largely due to the fact that they don't pay a dividend. But if you've watched my channel for any amount of time, then you know I don't just invest in dividend stocks. After all, my largest position, individual position I should say, is Alphabet, which not until just last week did it become a dividend stock itself. For those of you unaware, Generac operates out of the industrial sector, building various types of generators that are both used in commercial and residential use. The company has a market cap of $7.7 billion, and over the past 12 months, the stock is up 25%. However, here in 2024, the stock is flat so far. Generac also just released earnings, so we can get some insights into how the company is doing so far. They reported EPS of 88 cents per share, compared to analyst expectations of 71 cents, so easily beating on the bottom line. Revenues came in at $889.3 million, which missed analyst expectations by $3.4 million. So overall, a mixed earnings report. Revenue growth for the year was only 0.2%, but even with that, management still maintained their full year guidance, having net sales expected to come in between 3 and 7% growth on the year. A bright spot for the company was residential use generators, standby generators, and another bright spot was reverting back to positive free cash flow, something they didn't have during this quarter in the prior year. Last year, the company had negative free cash flow, and this year turned things around, generating a positive $85 million in free cash flow. When it comes to the upside of Generac, it's not only here in the US, which is where the majority of their business is. Only 20% of their business is outside of the US or internationally. That's also upside potential for this company moving forward over the long term. As I mentioned earlier, Generac doesn't pay a dividend, so we'll skip right to valuation, where analysts are expecting the company to generate 2024 EPS of $6.05 per share, which equates to 12% earnings growth year over year. That gives the company a forward PE multiple of 21.3 times compared to their 10-year average of 18 times. So likely a stock that you want to keep high on your watch list, but you also want to see that stock price come down just a tad before entering, or at least I do. Now let's take a look at what analysts believe. Currently, analysts rate the stock a moderate buy with an average 12-month price target of $140 per share, implying nearly 10% upside from current levels. And that leads us to watchlist stock number 3, which is Prologis, stock ticker PLD. Now we're going to move into the REIT sector, which is a sector I like a lot. However, over the past 12 to 18 months, the real estate sector has been one of the worst performing sectors to be in. Why, you might ask? Well, we went through rapid fire 11 interest rate hikes, and we now have this higher interest rate environment, higher for longer period, which has weighed on an interest sensitive sector like real estate as well as utilities. However, outside of this high rate environment, if you look back, dating all the way back to 1972, REITs, or real estate I should say, has been one of the top performing sectors in all of the S&P 500, outperforming the S&P 500 for much of that time span. Prologis is one of my favorites within the sector. And when you look here, you can see the company has a market cap of $95.9 billion, but over the past 12 months, shares are down 15%. Much of that, or even more of that, coming here in 2024, where year to date, the stock is down 20%. Much of it in the past few weeks. So what happened, you might ask? Well, recently, back in April, mid-April, I should say, the company reported its earnings, which beat on both the top and bottom line. However, the guidance was a huge miss, and we're going to take a look at that here in a second. But when it comes to investing, it's a lot less about what you did for me and a lot more about what you're going to do for me. So if you report good earnings, but your guidance moving forward isn't great, investors usually don't like that. Looking here, you can see the latest earnings. The company reported FFO of $1.31 per share. Analysts were looking for $1.29, so a slight beat there. On the top line, revenue came in at $1.96 billion compared to expectations of $1.83 billion. So an easy beat on the top. However, 2024 guidance came in light, quite light, with analysts looking for FFO guidance of $5.51 per share, and the midpoint of the guidance that management gave was only $5.42. So a sizable miss there, shares cratered. On the call, management alluded to high interest rate as well as geopolitical concerns, giving some of these new customers that are coming to look to open new lease agreements some reason to be cautious, and it's rightfully so. However, when it comes to investing, long-term investors like myself look at that as a short-term headwind. We're looking for value today, and that's why right now I believe that this is that accumulation phase when it comes to the REIT sector. You have the ability to not back up the truck right now, but take little nibbles, small buys throughout the next 6 months, 8 months, whatever it may be, until we get more insight into when rate cuts are going to start happening. Before we look at valuation though, let's take a look at the dividend, where PLD is a rare dividend growth REIT, as they yield a high dividend yield of 3.8% to go along with a 5-year dividend growth rate of 12.6% and 10 consecutive years of dividend growth. Now we'll turn our attention to valuation, where analysts are expecting the company to generate 2024 AFFO of $4.42 per share, giving them a forward price to AFFO of 23.5 times. 17% growth expected next year puts the valuation even lower at only 20 times. And that compares very favorably. Both of those compare favorably to the company's 5-year historical average of 28 times. So right here, we're looking at a high quality REIT with a great management team trading at a great valuation. Now let's take a look at what analysts think, where analysts rate the stock a strong buy with an average 12-month price target of $136 per share, implying nearly 30% upside from current levels. That is huge for a REIT. So again, REITs are going to stay compressed as long as rates remain high. Until we get further information about when rate cuts are going to come, that's when REITs will start to make their move. So now you can accumulate shares of high quality REITs like Prologis. So that wraps up today's video. We went through 3 high quality companies that should be on your watch list right now. Let me know down in the comment section which of these 3 is highest on your watch list. Which of these 3 are you likely to buy first among all of these? And if you haven't done so, make sure you smash that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.